Welcome to Multifamily Grit, where we bring in the experts to share the pros and cons and celebrations and struggles of one of the most important industries in the U.S., multifamily property management. Today, I am joined by David Strange, Senior Managing Director of Commercial Real Estate Finance at Walker Dunlop and co-manager of Walker Dunlop's Nashville branch. David brings over 20 years of experience in the industry, has created untold amounts of success for his company and his clients, and is one of the nicest guys you will ever meet. Before we get started, we are sponsored today by Walker Dunlop, one of the largest commercial real estate finance and advisory service firms in the United States. Walker Dunlop's comprehensive suite of financing solutions allows them to originate loans for their own balance sheet and investment partnerships, or for sale to Fannie Mae, Freddie Mac, HUD, life insurance companies, banks, and CMBS providers. Walker & Dunlop financing expertise, scaled lending platform, and unyielding commitment to client satisfaction make Walker & Dunlop a great choice for commercial real estate financing needs. And don't forget, if you like what you hear today, please like and subscribe. David, thank you so much for being here today.
Well, thank you, Kerri, and thank you for that absolutely wonderful introduction. I'm a little afraid to follow that with any Q&A.
Oh, I disagree. You've earned it. You've earned it. In fact, let's talk about that for a second. Yeah. So before we dig in, I'd love for you to share how you actually got your start in commercial real estate financing.
Well, this isn't my first career, but we had a family friend from 35 years reach out who was trending into retirement and asked me if I'd like to learn the business and take over his book of business. And I saw it as an opportunity to grow and took advantage of it.
Yeah, I love it. Looking back, good decision, bad decision, best decision ever?
Well, if you would have asked me in the first year or two, I would have said it was probably not a great decision because there's a lot of struggles along the way. But looking the full road back, it's been the best decision.
Yeah.
And I'm very grateful to the gentleman for the opportunity.
Yeah, I love that. Yeah. I say that a lot about joining Elmington 12 years ago, and you know those partners really well, that when I joined them, the first few months, actually, I'll share a funny story with you. My first few months with Kerri and Ben, I didn't really have I was still gaining access to all the data, right? Came to them as an accountant and didn't really understand everything. About 4 months in, the woman who was handling their company financials turned them over to me, and I called my husband and I was like, "There's no money to make payroll. I made the worst decision of my life."
Oh no.
No, of course, I walked into Kerri Rosenblum's office, and if you know him, he was like, "Oh, it's all part of the plan. It's totally fine. Everything's fine. Don't worry about it. It's all totally fine. Just go down to Scott's office, and we'll take care of it." I was like, "Okay, that's fine." But now I look back on it, and I say the same thing. Best decision of my life. One of my best decisions. Absolutely.
Sometimes the best way to understand where you are is to look backwards.
Yeah.
And now that I've reached the ripe old age of 50, I find that to be more true than ever before.
Yeah, I agree. I turned 40 this year. So
it's a couple milestones for us.
Yeah. I feel like I've had a lot of those thoughts this past year about looking back and looking forward and what everything means. So yeah, I think we're doing the same thing. That's interesting.
Well, I think we'll be doing some of that right now today too.
Yeah. I'm really excited to dig in.
Yeah, me too.
Yeah.
Well, let's get started.
Yeah.
Okay.
So for you have such a unique position. I think you have an incredible awareness of what's actually happening in the market, both from your day-to-day responsibilities, but also from your position at Walker & Dunlop and access to the data that you have. So I'd love to know, where do you think the market stands today?
Well, let's start with the economy.
Yeah.
The economy today has an inflation rate of 2.9%. Down from its high of 9.1% in 22.
Mm-hmm.
And, well, I shouldn't say 22. I think that was it, 22.
Yeah.
And the Fed has now come out and said that they're going to start making some cuts to the Fed funds in order to manage to the policy rate target of 2%.
Mm-hmm.
And they're going to do that as soon as possibly next month. So that's good.
Yeah.
On the labor side, I believe we have a balanced labor market now with a 4.3% unemployment.
Yep.
The rest of us outside of, the economists would like to see 0%, but that's not obviously the formula for a balanced market.
Yeah.
the supply constraints that we have endured since the pandemic, those have been normalized. So we have a healthy supply chain in place to provide for the demand, all in all speaking.
Yeah. Yeah. I think that's a really good summary of what's happening. And I think it is really, talking about looking back, it is really incredible to look back at what we have gone through over the past 3 years and the incredible fluctuations in the market and to where we are today, and things really start to feel like they're stabilizing in a really healthy way.
I think so.
Yeah.
We started kind of feeling internally a little bit of positive movement over the last 60 days.
Okay.
We've had some assets lock up on some construction financing that had been stalled out for quite some time, and we can get into that in a minute as well. But and that all is a result of a couple things. It's hard cost related, so construction costs coming in a little bit.
Yeah.
And the theme of this conversation could be supply demand, economics 101.
Yep.
And this is exactly the result of those pricing components coming in. And then we received quite a bit of help on the interest rate, on the cost of debt.
Yeah.
So that at the end of the day, a developer, owner, operator could justify a return in order to build the asset. So we've started to see that turn, and we anticipate seeing, now that the momentum has started, the momentum carrying forward, especially with the Fed's latest stance.
Yeah, that's fantastic. So I'd love to dig into that a little bit. So where do you think the market is today on the housing front?
Well, I mean, if you look at single family, and we'll start there, single family as a comparison to household median income, the average price of a home today is 7 times the average median household income.
Yeah.
To put that in perspective, 50, 60 years ago, that same ratio was a 2-to-1 ratio.
That's incredible. You shared the statistic with me, and I was floored. I had no idea.
Yeah, and it's not something that popped up over the last 36 months. This has been a progression over the last 50, 60 years, moving up. And so that's been the trend. And, I believe that there's going to be some opportunities in the near term to solve for that and maybe even reverse the trend. On the multifamily front, it's a little different. We are up 30% on average rents from the beginning of the recession. And so that is 100% due to the last 36 plus months.
Yeah. Yeah. I love the way that you're looking at this in terms of whether this is a situation that's been caused by the pandemic or something that has been happening over the course of 60 years and that maybe wasn't even impacted by the pandemic at all. But I think it's so interesting to look at it that way. And when you and I talked about this and you shared the statistic with me, I was floored because I've never seen that in my lifetime, where the average home cost was only 2 times that of the average median income. So I was absolutely floored. But to know that it's 7 times, I mean, we talk about affordability of homeownership these days, and hearing that stat, it's no wonder it's so difficult for someone to actually own a home. But you mentioned that you see a situation in which this trend could be reversed. I'd love for you to talk about that.
And we're going to speculate. So I'm either going to make a fool of myself here or I'm going to seem brilliant. So here's to a brilliant conversation and thought. But one of the biggest concerns right now to some folks, and it's caused by fear and maybe some of the excitement because it creates opportunity, I think, is AI. And so if you were to, and I'll speak from a multifamily development perspective, that's where my experience really resides. If you look at what goes into a multifamily development, you have hard costs and soft costs. So let's pick one of those. And the easy one for me to pick would be architectural plans that go into ultimately being built. Yeah. Those plans take months to design based on, configuration, topography of the land, zoning, regs, so on and so forth. And they're very costly, hundreds of thousands of dollars.
Absolutely.
And that's added to the bottom line.
Yeah.
Well, what would it look like? And again, architectural, like accounting, you're an accountant. I mean, you deal with facts. A plus B equals C. So it's understanding those facts that lead to that sum. AI is a ridiculously efficient tool to take facts in order to recognize the result of those facts. And so if you have facts based on topography, site, if you have facts based on square footages, they pull from the market. What's the ideal unit mix based on the demand in the market? Is it ones, twos, and threes? What's the square footages? AI pulls all of that information and drops together a set of plans that is in compliance with zoning and codes and regs. And they do that, let's say, in minutes. Now, that sounds crazy.
Yeah, saving you hundreds of thousands of dollars.
In minutes.
Yeah.
Like, it's, again, these plans take 6 months to do this with, the human and kind of going through the process that they've always done. And this is not to suggest that we no longer need architects.
Yeah.
What it suggests is that the architects now can take on a larger caseload with less resources. And so they're still able to continue to thrive, but it's thriving in a different way.
Yeah.
The developer is then taking on less cost to the project, still looking for the same return. So ultimately, if you have enough of those components coming together that save cost, then you're able to have an opportunity to then reverse that trend and come back down on your rent level or your sell price.
Yeah.
As a comparison to income.
Yeah. Okay. I'm going to call it genius. And I'm also going to say that if you want to have a whole episode devoted to all the things that you think that we could be doing in order to create or to reverse that trend of increasing housing costs, whether that's single family or multifamily, I'm here for it. So.
Okay. Right.
I think it was fantastic.
Well, thank you.
Yeah. And so, okay, so your synopsis of like where we are today and kind of what the market's been doing over the past 3 years and or 60 years. I'd love to know, how do you think we got here?
Well, where we sit today is really driven back to the supply demand. And demand got completely severed at the onset of the pandemic. And you'll recall that no one was able to leave their home. No one was able to go into work. People were getting a call on Thursday, go home, come back on Friday, get what you need, and do not report back until you hear further. Well, for some of us, that was okay because we could work from home. We discovered what Zoom was. It was more than a conference call system. It has video, you know, and I'm one of those that didn't even really pay attention to Zoom beforehand. But you also had the folks that worked in the factories, in the plants. You had the overseas shutdown. This was a global break of the supply chain, the global supply chain. So when you have demand, whether it's growing at one pace or another, but you completely basically sever the supply chain, that demand becomes precious and way more expensive because there's only so much of it. And I'll share with you an example, and you'll remember like the chips that go into automobiles and all that stuff. About that time, during this time, I had bought a new truck, and I did something I had never done in my entire life. I paid MSRP, and I thought only fools did that. You know, I negotiate those things down. That's what you do. But I was happy to pay MSRP. I put about 17,000 miles on it. 12 months later, sold it for 15,000 more than I bought it for. That doesn't happen when there's supply. So this was one of the causes of all the costs going up from the construction. Then margins were able to follow as well because of the work, and there's only so much availability. Trying to find a sub base for a job became extremely difficult. But the most difficult thing may have been keeping that sub base on site. Very easy for that sub base to walk across the street to a higher paying job. So that was one of the big things. Then we got hit with a deep but relatively short recession in 2020. We had the labor force, almost a labor exodus. So when everybody was sent home, some people said, I can't do this, I resign.
Yeah.
Some people said, oh, this is an opportunity for me to go kind of do something I've never thought about doing. I'm going to chase my own passion.
Yeah.
Some folks retired. Whatever the case, we had created then a labor shortage. And to kind of put that in perspective, the job openings this was 22. Job openings in 22 were twice that of the unemployment level. Significant job shortage.
Yeah.
And then, we had additional COVID waves, COVID variants that hit. And then Russia's invasion of Ukraine.
Yeah.
And that spiked our energy and commodity pricing. So before you knew it, we're at a 9.1 inflationary rate. And this is where then the Fed said, all right, we have this tool. And the tool, though, is sitting, which is the Fed funds rate, is sitting at 0 to 0.25%.
Yep.
And they said, we got to stop some of this spending, especially on the borrowing level. And so what they did is they aggressively campaigned to move that policy rate up. And today it's at 5.25% to 5.5%. And it's been sitting there over the last year.
Yeah. It's, I know how that would have impacted me in so many ways, but I'd love to understand what the impact has been to like the housing market in a bigger perspective. And I feel like I started our conversation this way, but really want to hammer it home. You are in such a unique position to understand this and truly how it's impacting us today. Like I said, from all the research and data that you have from Walker and Dunlop, and also from boots on the ground, actually working with your clients who are trying to get these multifamily assets off the ground, like the one that you said, the 2 new construction projects that finally were able to pencil and you were able to lock them in, which is fantastic. So what is the impact that this has all had to housing today?
Excuse me. Well, I'll start with the single family front again. So when rates were 3%, every single family opportunity to purchase was purchased at a level that typically may have hit the higher threshold because they were able to afford more than they otherwise could have.
Yep. Yeah.
So when you look at a housing ratio, whether it's 32, 35%, whatever that housing ratio is, they're financing at the top of that ratio at a 3% rate. And let's assume they're buying a $500,000 house. So they're taking out a $400,000 mortgage at 3%.
Yep.
Almost overnight, with the aggressive Fed campaign to increase policy rate, it doubles. It more than doubles.
Yep.
And so now, if it's a first-time home buyer, now all of a sudden we can return that their forever home because there's no way today they can go and buy that same house that they're in at the current cost of debt.
Yep.
And so furthermore, if they can't do that, then they can't do one of the 3 exercises that's typically made when you leave an existing home to move to another home, which is you move up in square footage, you move locations, or you downsize. So it's obvious you can't do the first 2. And if you did the last one, it was probably a bad decision.
Yeah. Yeah.
So anyway, so what happened was that sidelined all of the existing home sales inventory. It basically was none. So it spiked new construction for single-family home builders.
Yeah.
And I think there's a couple crazy percentages out there as to the jump in new construction starts. I think it was around 50% increase. So, and that kind of speaks to the demand. And so obviously the prices, the margins went up on those ends. And so the relief will only come when those rates come back down and people can exit their existing homes and put that inventory back in the market. On the multifamily front, as far as construction is concerned, the opposite is true.
Okay.
On the multifamily front, when you're looking at a deal as to whether it's going to pencil or not, to your statement earlier, you're looking at your cost basis plus the cost of debt, and you're comparing that to the NOI.
Yep.
Revenue less expenses. How much of that can feed, and then how much of that can I have left over?
Yeah.
For my returns.
Yep.
So we'll call that cash flow. And when it was 3%, the 3% rate was really a bandage to the historic high construction costs that were going around. So every developer, builder was bitching because of the high cost.
Yep.
But at the end of the day, it really didn't matter. It was just a choice. Do I want to build it or not? Because I still have my returns.
Yeah.
And, oh, by the way, I have the value on the backside because rents are skyrocketing.
Yep.
And what happened was when these rates spiked, it went, again, doubled.
Mm-hmm.
And so the NOI was not healthy enough. The market did not support
Yep.
a rent high enough to support both that higher cost of debt and that high existing cost to build.
Yep.
And so the returns weren't there. And so, I mean, everything, again, got put on hold or sidelined.
Yeah. I want to go back to single family just for a second because I have a question. So you mentioned that single family buildings skyrocketed due to demand. Do you think we have enough single family today? With that, was it, I guess, was the drastic action that was taken, was it helpful to the market?
That's a great question, Kerri. And so I think you look at it a couple different ways. One, I think that we don't have enough affordably priced housing.
Yeah.
Right. And that's a separate topic or issue.
Mm-hmm.
Then do we have enough ownership in America?
Yeah.
Enough housing,
Yeah.
single family. And, you know, if you look back to the last 50, 60 years again, home ownership in America has been around the 65% range.
Mm-hmm.
All right. Today, it's 65% range. So it's not like we slid backwards into a renter society.
Yeah.
But we're also not an ownership society.
Mm-hmm.
And I don't believe you need to be one or the other. I think you need a healthy mix.
Yeah.
Because we're not all the same
Yep.
in our ambitions, desires, interests.
Yeah.
And so I don't know that we need necessarily more single-family homes than we need multifamily rental, for instance.
Yep.
But I think we do need to really focus on the affordability component to housing.
Mm-hmm.
Because while there are many folks that are okay, there's a lot of folks on a moderate fixed income, and that fixed income has not adjusted to take on the significant cost increases.
Yeah.
It's significantly outpaced it, and it's putting a lot of stress on those incomes.
Yep. That was such a great answer for my next question, which is, what are some potential solutions for the future of affordability?
Well, I think supply.
Yeah.
Supply and supply. The more supply that you put, the more cost competitive environment we're going to have, and it's just going to drive pricing down. The second thing I would say are options. I think more options that are available. And third, I think a cost conscientious build.
Yes.
If you, again, and I kind of going back to 50, 60 year period, because I think going back 100 is too much. But we're talking a generation or two when I mentioned that. 50, 60 years ago, the housing envelope was half of what the housing envelope is today.
Yep.
So that 7-to-1 ratio is not necessarily an apples-to-apples comparison because we're building twice the size. We don't need, do we need? I don't know, twice the size. And the question would be further complicated with, okay, well, let me ask you if we need it, but then also state that 50, 60 years ago, the household had more people in it than we do today.
Yeah, inversely. Yeah, it's interesting.
And so the square footage per person,
Mm-hmm.
even if we were to come down to the total home square footage, is still going to be greater today than it was back then.
Yeah.
So one, maybe we look at building as an opportunity to build affordably priced housing. We build smaller.
Mm-hmm.
Second is what's going into the finishes of the house. Does every house need crown?
Yeah.
You know, I mean, when I bought my first house, we didn't have wainscoting and a lot of crown, but now I see almost every house being built has all these fits and finishes.
Yeah.
Maybe we pull back on some of that, and the homeowner, as they save, they can either do it themselves, learn how to do it themselves, or hire it out as that opportunity from an income standpoint presents itself. But unload the cost sheet, if you will, on the build.
Yeah, I think that's so smart. Do you obviously engage with a lot of developers in this area? Do you know anyone who's doing that today, or who's thinking about it?
There's a couple of nationally recognized groups. One east of us, Clayton Homes. I believe they're starting square footage is less than 1,000.
Okay.
And D.R. Horton is another one.
Yeah.
And those guys are both doing it really, really well.
Yeah.
And I just think you need more of those guys, really kind of focused on this smaller build. You know, we talk about affordability, and while home ownership, and we're talking about how do you build for a for-sale opportunity the most affordable product. Today, still the most affordable housing is rental.
Yeah.
You know, I'm gonna swing back to the smaller cost. You know, one of the things that we were talking about was the ticket price. Like, how much it cost to get in?
Yeah.
But if you have a smaller home, you have less utilities.
So true.
Air, heat, electricity, gas. You have less furnishings.
Less stuff.
Less stuff.
Yeah.
Less repairs, maintenance.
Yeah.
It becomes more manageable. And so, you know, if you're a first-time home buyer, the idea is that you're not going to stay in that home forever.
Yeah.
Or if you're on a fixed income, the idea in both those situations is have money left over to invest in other things or save, not rely 100% on your home. I think that's a bad idea.
Yeah, I agree with you. I think it's really interesting to look at this from a generational perspective too. I know that I'm a millennial, on the older side of millennials, but I'm a millennial, and I think we still ride that wave of more is better, of having more stuff is good. But the generations below me, I have actually brothers in the younger generation, and they both are of the mindset of less. Like, they have much smaller spaces. They spend their money on doing things, not buying things, but actually experiencing things. And so I think it's interesting, and I think that we're starting to see this shift in mindset as well. So hopefully that follows suit well.
Yeah, I think that's a healthy mindset.
Yeah.
You know, the opportunities to go and do things and have experiences, whether it's travel or what have you, I think is a healthy part of life.
Yeah.
And you know, if you're tied up with every dollar going into a home, that can be stressful, and you get lost experiences as well.
Yeah. Yeah.
Yep.
So I want to ask, Hunter Nelson and I recorded an episode, and he was very comfortable getting into the discussion of the upcoming election. And I know that, and although he's funny, he claims he's purple, so he felt very comfortable just stating the facts of the situation, which it was a very interesting episode. You know, Hunter, he's the best. He's brilliant.
Smartest guy I know.
Yes, so very confident about speaking to a lot of these facts, which I think was great. But you've actually shared with me some of the Harris campaign's initiatives. And so I'd love for you to share that here.
Yeah. So Vice President Harris has made a statement that if elected in the first year of the first term, she would add 3 million homes. And I don't know if that's centric to diluting it more towards home ownership in America, or if it's directed towards affordability, or it's a combination of both. I don't know. But let's just assume that it's really an affordability topic, because that's what I would 1,000% support.
Yeah.
And let's just assume that that's a $350,000 home, give or take. I think that would be absolutely wonderful, and I stand completely behind that stance. My question is, how?
Yeah.
Identifying sites and getting them properly entitled is an expensive, time-consuming process. So if this is something that she plans to do, she probably needs to figure out a way to get it done really quickly by working the federal level, working with the local levels, identifying those sites and figuring out an expedited way for entitlement. If you can do that, you're going to have contractors knocking down the doors to build.
Yeah.
One, that takes that off of them. And two, it also removes that cost. And if it removes that cost, then they can sell that product, that end product, at a lower rate, again, creating the affordability component.
Yeah.
So, yeah, I'm suggesting using some federal funds to get that front piece accomplished.
Yeah. And I know you mentioned to me that that this may be something that's restricted to first-time home buyers?
Well, that's what I think that's what she stated, first-time home buyers. And that is something that I would not be in support of.
I agree.
I don't know why you would restrict it away from any financially capable, credit-worthy applicant. It doesn't seem to go along with the rest of the democracy of, it seems like a little bit of discrimination, to be honest with you.
Yeah.
So I would not support that in any way, shape, or form. And let me kind of elaborate on that. Is that in the best interest of the first-time home buyer?
Yeah.
If someone is an existing homeowner and wishes and qualifies to buy this new home, one of these 3 million homes, then that means they're leaving a home behind. And in most cases, that home is going to be less expensive and more affordable to the first-time home buyer. Exactly.
Yep.
And so would that not be a better option for a first-time home buyer? Or at least an added option?
Yeah. I align with you on this completely. I think that the overall purpose of the policy to create more supply is exactly in line with what the market needs. What I think the problem comes in is when we try to control the market, the natural and organic flow of the market by doing something like only allowing that to be used by first-time home buyers. That creates a lot of issues. So I think we identify that there's a need, more supply. So let's create a policy that creates more supply, but we don't need an additional policy on top of that that then creates restrictions for the natural flow of the market, which I think is exactly what you were saying.
Yeah. Well, and I'll pick on President Biden too a little bit. He's come out with an asinine idea to cap market rate at a 5% annual increase.
Tell me how you really feel about that.
Well, I don't feel so great. It doesn't work. It doesn't make sense. And again, you can tie our whole conversation to supply and demand.
Yeah.
If he wants to control rents, then add more units. That's the natural solution. And it's the healthy one.
Yeah.
You're talking about disincentivizing development, and go ahead and start putting caps on market rate and see how that goes.
Yeah, I couldn't agree with you more. And I think that there are so many other ways to achieve that goal of creating more supply. And you've talked about a lot of them here. I mean, you could even incentivize builders. We could create federal programs to incentivize builders to build smaller, more affordable homes. We do not need to, again, create that second layer of policy that arbitrarily impacts the natural organic flow of the market.
Absolutely. And, we already have products and avenues, and Elmington is an expert in this one area as well. Affordable housing. It has caps already. It's already been addressed through that avenue and continues to be addressed. And just for the listening audience, what that means is you have an income qualified tenant, and the rents are restricted to 60% of area median income, AMI, or less. And so that already exists. And then you have the market rate, which is driven by the market, supply demand. But then you have this middle section, and this middle section is actually an area of severe need.
Yes.
We need to focus some attention there because it's termed missing middle or workforce housing.
Yep.
And so what has happened is you have a individual that makes too much to qualify for the affordable, but they don't make enough, or it's super stressful to the financial position of that individual to qualify for market rate.
Yep.
So they're literally stuck in this quandary of the middle.
Mm-hmm.
And that has multiplied on itself over the last decade.
Yeah.
And there's an understanding of maybe a restricted level of AMI to address that, which has been like 80% of AMI to 120%
yeah.
of
I see
AMI.
a lot of that right now.
Absolutely. And, there's states, I guess, that are looking to implement some sort of assistance in order to justify those lower rents to help on the source side along with the debt.
Yeah.
And I think of Florida has come out, and they haven't really buttoned it up, but it's called Live Local.
Yeah.
So they're trying to, figure out a way. I think if we could figure out a universal solution, I think that'd be better than having multiple local level solutions. But that is something that really deserves a ton of attention.
Yeah, I agree. I think that you articulated that really well. And I've actually seen, especially working with a lot of developers these days, where there are a lot of local incentives, like pilot programs that are incentivizing developers who are building the higher end product to provide set aside a certain number of units at that 120% of AMI and restrict that income, or restrict the rent on those specific units for income qualified individuals or households, and then providing those incentives back to the asset, which I think makes a lot of sense to do that as well. And I will agree with you that, in my opinion, creating these programs at a federal level is much more accessible than allowing the states or even specific municipalities to create these programs. In fact, just a quick sidebar, but low-income housing tax credit is one of the most effective programs designed for creating affordable housing in the U.S. today. The problem is it is actually a federal program. It's an IRS program, but it's allowed to be administered by the states. So that means that every state is allowed to create their own structure and process and forms and data sets for the LIHTC product in their state, which then creates a massive accessibility problem for owners and operators to make sure that they're abiding by those state-specific requirements and the state-specific data that's different from one state to another. And so if we're continuing on this conversation of creating more supply in the market, we really need to create accessibility for creating that supply and creating a federally implemented program that does not vary state by state, which creates a massive burden, I think is really smart.
Yeah. Well, and building and financing and operating an affordable development is much more difficult than a market rate. And so to your point, how can we alleviate the difficulties to incentivize more people to do it?
Yes. Yeah. Not going to happen through rent caps.
No, it's not.
I agree with you on that. I wish I disagreed with you, because I feel like we could have a really fun debate, but I agree with you, so I can't. Okay. So, we've actually talked about Nashville a little bit, but not specifically. So I know that you had mentioned what's happening in Nashville right now with all the Class A. I wonder if you want to comment on that.
Well, I just believe that evidences the point of supply demand and letting the supply control the rents.
Yeah. So what's happening in Nashville right now?
So what's happening in Nashville is we have a supply dump.
Yeah.
So when rates were low and demand was high, everybody that could did jump into the market.
Yeah.
And so I believe like right now at any point in time we got about 17,000 units flooding the market.
It's incredible.
And so you went from the highest of rents without any concessions to currently, I mean, there's up to 4 months of concessions.
Yeah.
So again, to your point, No one's imposed a rent cap, not needed.
Yeah.
It's imposed by itself by the supply.
Yeah.
I do think, and this is not necessarily just geared towards Nashville, but when you see situations such as this, you also see a stall in the supply chain, not of what's coming on now, but what's to come on in the future. So if we were to go and present a new deal right now in the urban core of Nashville, we probably wouldn't get a lot of interest. And because of that, there hasn't been a lot of permits issued over the course of the last 6 quarters, let's say. But in Nashville, we still continue to have the demand drivers, which are employment growth and immigration. It has not stopped.
Yep.
And so as long as you have those components driving demand, then once the dump gets stabilized, you're going to have a lull.
Yeah.
And that lull is going to drive demand through the roof. And so once you then start to relieve that, those new units coming online as well as the existing units during that period of time, you're going to see a heightened level of rents again.
Yeah.
So it's going to ebb and flow. And that's shows you both sides of the supply chain and what happens when you supply and when you don't.
It's so interesting to look at it that way. And it's a frustrating cycle of the market. I think that, as you mentioned, because there's so much supply right now, permits aren't being issued, which means that we are not going to see supply in the next 2 to 3 years. There's going to be a huge lull, which means at that point there's going to be the demand is going to outweigh the supply, which means now rents are going to increase again until that supply comes back around.
Correct.
It's a frustrating cycle, especially for renters.
Yeah. No, it is. And, you kind of see the renter of today is twofold. When I was coming out of school and renting, it was a need.
Yeah.
Right. And today, in addition to the need, you're seeing a lifestyle choice. They want to be around the walkability. So they're willing to put up with those cycles.
Yeah.
What happens is when those cycles settle, that means that your growth has settled, right? And so to add a new development could be, a very big risk.
Yeah.
Can the market absorb another 300 units in pretty much a stable market without any real growth?
Yeah.
I think as long as you have growth, you're going to have that roller coaster ride because, unless the permits are controlled, coming out at a slower pace.
That's interesting. Yeah. I have a question for you that someone has asked me before, and I'm wondering, I'd love to know your take on it. So you mentioned, and we're seeing it right now, 4 months free rent on brand new Class A lease-ups in Nashville. Why aren't they just reducing the rental price? Why are they doing 4 months free concessions?
All right. So think about it this way. If I'm a leasing agent and you're coming in to lease an apartment,
Yep.
What I want to do is I want to set expectation. And I want to set expectation for where the market is without the dump. And the market is suggesting $2,500. So why don't I just reduce it to $1,900? When your lease comes due, you're more likely to renew at the $2,500, which you've been paying, and you've forgotten about the concessions, or even pay a little bit more than if I set your lease at $1,900 and I'm going to try to push you up to $2,500, $2,600. So there's a better chance to retain on a lease term that tenant.
I don't disagree with you. However, if that were the way that it was actually being used, but the way that we see most of those concessions happening these days is that the concessions are actually being applied for the term of the lease, right? So you are actually paying $1,900 a month. You're not actually getting 4 months free on the front end. And a part of that is actually by design for the developer and the owner because they don't want to go 4 months without receiving any income. So they're not actually doing 4 months.
Right.
Truly free, right? They're taking that concession and spreading it over the term of the lease, which means they are actually paying $1,900. And I would argue, I'm not an economist by any means. However, I am an economic purist, and I truly believe that if the price that it takes to lease that unit is $1,900, that's the value of that unit today. And that dump or not, it doesn't matter. It doesn't matter because implying that it's because of the dump means that you know that in 12 months there's going to be a different scenario, which we do not know. So I truly believe the unit's worth $1,900, but it's just so interesting to me to see how that happens. And I've seen a lot of renters become infuriated, being a partner in a property management company. Yeah. Those renters are infuriated when the rent goes from the effective rent of $1,900 a month to $2,500 at renewal. So I just think it's interesting the way that we're approaching this. So.
Yeah. So on the property management side, how do you underwrite them then? If you're giving them 4 free months, and the actual gross rent though is showing 25, do you underwrite them on the rental ratio or housing ratio at the 25, or do you do the 19 spread out?
Well, as a property management company, we don't really underwrite, but if you
or
mean
qualify.
Okay. So it depends. Most of the time, we're actually qualifying them at the lower rate.
Yeah.
Yeah.
Okay.
Yeah. I mean,
so
honestly,
there's a good chance they couldn't even qualify at the higher rate. Yeah.
Yeah. Yeah, exactly. So then when I go to increase their rent, I don't requalify them when I go through the renewal process. So when I go through the renewal process, then I come in and I say that it's $2,500 a month. It's up to them to come to me and say, I can't afford this. I can't afford $2,200 a month. And so we settle somewhere in the middle.
So you may end up with a tenant in a unit that quite honestly is not qualified for on the turn because they're not requalified. And it's jumped up to what the market suggest without all the inventory trying to lease up in the market at the same time. Yeah,
although it's interesting to even talk about the concept of like a qualified renter based on their income, because a lot of sources today would tell you that you shouldn't even use income as a multiple of rent to determine qualified, especially when you're talking about Class A assets, because if someone has 3 times as much as the rent, right, and their income is $9,000 a month, they have $6,000 of cash flow that they could use elsewhere, versus someone who's making 3 times rent, which is and their rent is $1,000, and they only have $2,000 worth of cash flow post rent. So a lot of sources would say it's not the way that you should actually look at rental qualifications anymore, which is really interesting. So, and we work with groups like TransUnion and Equifax who would argue that you should utilize a renter score, and you really shouldn't even look at their income anymore, because the score of that renter, not a credit score anymore, it's like an overall health score of the renter, because they have access to so much data, not just their credit data, would tell you so much more about that household's ability to figure out paying rent. I mean, sometimes they have income that they're not reporting, whether that's like tips or other. So, but it's just that how seriously does that household take its financial responsibilities, and it has a score related to that, and that's all you should look at, which is really interesting. So, yeah.
Well, you've kind of gone over my head with that piece. I apologize, but
it's okay. You were over my head with most of this conversation. I'm trying to keep up with you. But you're an expert in your field, for sure.
Well, you are as well.
Thank you.
Thank you.
Well, honestly, David, I've had such a great time. So thank you so much.
We should do it again soon.
Yes.
Yeah.
But before we go,
our
listeners love to hear a story.
Story.
Yes, I'd love if you could share.
How about the story where I was confused on the qualifying piece?
Like I said, I've just been trying to keep up with you this whole podcast. So.
Oh, yeah, you did great. I don't believe it. A story related to the industry.
Yeah, the real estate industry.
All right. Well, I'm going to tame this down a little bit.
You don't have to.
When I first, I may have to.
Wait until you listen to Hunter's story.
Oh, my goodness. I can't wait to hear it. He's a great storyteller, too.
It's a good one.
When I first stepped into this career, we were doing a lot of things that we no longer do. So we would literally go out and shop comps and with cameras and go in and get the renter package, to understand the rents that they were leasing at and this kind of stuff. So one of the things I did is we had an application for a refinance that we were looking to potentially take on.
Okay.
And so we were required to go and do a site inspection. And that's still required, but not all parties to the transaction.
Yeah.
And so we had a gentleman from San Francisco fly in as the underwriter to also participate in the
Unit walk.
In the unit walk.
Yes.
And this was a Section 8 property that we were looking at, and the gentleman that flew in, I mean, he was dressed to the nines, didn't have a hair out of place, just
full suit, fancy shoes, ready for that unit walk.
All of it. And so we show up, and the leasing agent actually could have served as a bodyguard. I mean, she was really established in the community and knew her environment.
Yeah.
So we started walking one of the units, and we're inside, and it's a unit that they're painting and, what have you. And he is standing beside me, and the leasing agent looked out and just started yelling at a guy. And he was urinating on a wall. And she's, stop, whatever. Words came out of her mouth.
Imagine.
Yeah. He turns around with no need to zip up or anything, with a hand on his back like he was going to pull out on her. Next thing I know is this gentleman dropped to the floor like a sack of potatoes, and he did an army crawl out the back door faster than Carl Lewis would run the 40. And so I'm kind of watching all this, and, I'm seeing it, but at the same time, I'm laughing at this San Francisco, put together, dressed to the nines, super trendy, drops to the floor, army crawls out. They kind of settle up. I mean, it really wasn't anything.
Yeah.
And we're like, well, where's such and such? So we walk out the back, and we're like hollering for him, hey, it's clear. Come on back around. He comes around. Are you sure?
Oh, my gosh.
Anyway, it was much funnier at the moment, and I literally had tears coming down my face just laughing at him just dropping and army crawling out the back door.
So funny. That's so funny. Well, you would appreciate Hunter's story because it also was about a unit walk. I feel like we all have such incredible stories. Unbelievable, almost, their stories. I mean, my husband's a detective in Nashville. And
well, you have the best stories, I'm sure.
Oh, he has.
Oh, my goodness.
He has insane stories, honestly. But back when I was full-time at the property management company and on site a lot, we would just come home and trade the most ridiculous stories. I feel like if mine could stay on par with that, the multifamily property management is a whole world. So it really is. But I appreciate it. Well,
you bet.
David, thank you so much for being here today.
Well, thank you, Kerri. I really appreciate you having me.
Well, I appreciate you taking the time, and I feel like our listeners have probably learned so much. I have learned so much. It's been a really enlightening and fun conversation. Like I said, from the very beginning, I know you have such an incredible view and insight into this industry and into this world. So thank you for sharing it with us.
Well, thank you. I appreciate it.